Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance with a smile and maybe raise an eyebrow or two. Today we are diving into something that might sound a bit dry but involves some serious money changing hands. It is about Blackstone's private equity funds. We're going to look at what they sold, how much they made, and what it all means for investors. Alright, so we are looking at reports filed by two Blackstone entities, Blackstone Private Equity Strategies Fund LP and Blackstone Private Equity Strategies Fund TELP. These are essentially investment funds designed to pool money from investors and put it into private companies that are not traded on public stock markets. Think of it like a big club for wealthy investors who want to invest in businesses before they become huge or famous. The main event here happened on the 1st of September of 2025 when these funds sold some of their partnership units. Now, when we talk about selling units in a fund like this, it is not like buying a single share of Apple on a stock exchange. It is more about investors putting in money to become part of the fund, or in this case for the fund to perhaps adjust its holdings or bring in new capital. The total money this involved across both funds was a whopping $422.8 million for one fund and $130.5 million for the other. That is a lot of zeros. Let's break down what kind of units they sold to get a clearer picture. The Blackstone Private Equity Strategies Fund LP sold a bunch of different classes of units: Class I, Class S, Class D, and Class N, for example. They sold over 8.3 million Class I units, raking in nearly $269 million just from that one class. Then they sold some Class S units, bringing in another $148 million. The D and N classes brought in smaller amounts but still significant figures. Now, the other fund, Blackstone Private Equity Strategies Fund TLP, which is set up to help certain investors like tax-exempt or international investors participate in a more tax-friendly way, also sold units. This fund is basically a way to invest indirectly into the first fund. It sold its own Class I and Class S units, bringing in about $66 million and $62 million respectively. It is interesting to note that this second fund, the TELP, actually bought a considerable amount of units in the first fund, the BXP USLP. This is by design, as the T fund invests all or most of its money into the main fund to offer those tax benefits. So, while it looks like separate sales, a significant portion of the second fund's activity is actually an investment into the first. These transactions are part of a larger program called the BXP Fund Program. It is not just these two funds, other Blackstone managed vehicles with similar goals are involved, making the total money raised in this program approximately $740 million. This shows that Blackstone is actively managing and expanding its private equity operations quite significantly. Now, how did they sell these units? They did it through what is called a continuous private offering. This means they are selling to a select group of investors who are both accredited investors, meaning they have a certain level of income or net worth, and qualified purchasers, which is a higher bar requiring even more wealth. These sales are exempt from the usual registration requirements of the Securities Act because they are private deals, not open to the general public. This is typical for private equity funds. Okay, so we've talked about the money changing hands, but how much is each unit actually worth? That is where the transactional net asset value comes in. This is basically the value of the fund S assets minus its liabilities, calculated on a specific date, in this case the 31st of August 2025, to determine the price for these unit sales. Looking at the transactional NAV per unit for Blackstone Private Equity Strategies Fund LP, the Class I units were valued at $32.12. The Class S units were a bit less at $31.67. The Class D units were close at $31.99, but the Class N units were significantly lower at $25.46. This difference between classes often relates to fees, minimum investment amounts, or other specific investor terms, indicating that not all units are created equal in terms of their underlying value or investor benefits. For the Blackstone Private Equity Strategies Fund, TLP, the Class I units were valued at $31.86, and the Class S units at $31.41. Interestingly, the feeder fund S-Class I units were valued slightly lower than the main fund. S-Class I units, which makes sense given the fees and structures involved. And to put all this into perspective, the entire BXP fund program, including all these different vehicles and investments, had a total transactional net asset value of around $14.2 billion as of that August date. That's a massive amount of capital being managed by Blackstone in this particular private equity strategy. The way they calculate this transactional net asset value is based on the month end values of everything the fund owns and owes. They adjust for things like organizational costs over time and ongoing fees, but they might not account for certain potential tax liabilities if they are not sure they will actually occur when an investment is sold. This can mean the transactional NAV per unit is different from its official net asset value calculated under standard accounting rules. So, what does all this tell us? We see significant capital deployment and adjustments happening within Blackstone's private equity funds. The fact that they are continuously offering and selling units suggests ongoing fundraising activities and a dynamic approach to managing investor capital. The exemption under Section C, A, and Regulation D highlights the exclusive nature of these investments, accessible only to sophisticated and wealthy investors. The signatures at the end, coming from Christopher Striano, the Chief Financial Officer for both funds, simply confirm that these filings are accurate and officially submitted. It is the formal sign-off that everything we've discussed here is a matter of public record for the Securities and Exchange Commission. Now, let's look at the bigger picture here. Blackstone is a giant in the alternative asset management space, and private equity is a huge part of that. What we're seeing in this report is a snapshot of their ongoing operations, specifically the flow of capital in and out of a particular private equity strategy. The sheer volume of money involved, billions in total net asset value, and hundreds of millions in unit sales, underscores the scale of their operations. The different classes of units and their varying net asset values per unit are common in private equity. They allow funds to cater to different investor needs and risk appetites, often through feeds or specific liquidity terms. The fact that they use a transactional NAV, which might differ from a GAAP net asset value, is also standard practice. It is designed to price transactions accurately based on current market conditions and fund expenses at that specific moment. One of the key takeaways for us as observers is the confirmation of continued investor appetite for private equity, especially with a manager as reputable as Blackstone. The use of Regulation D offerings means these are not investments you'll find on a public exchange, so access is limited. This also means a higher degree of risk and less transparency compared to public markets. For investors in these funds, the main risk is illiquidity. Their money is tied up for years, and the valuations are estimates until an actual sale of an underlying asset occurs. Looking ahead, Blackstone's strategy with these funds, as indicated by the continuous offerings in the program structure, is about steady growth and capital deployment into private companies. This is a long-term game driven by their ability to identify undervalued companies or those with significant growth potential, improve their operations, and then exit those investments profitably. The current filings don't reveal the specific performance of those underlying investments, but they do show the machinery of capital raising and allocation is operating at full steam. So, what is my take? Blackstone is doing exactly what they do best, managing vast sums of money for sophisticated investors and deploying it into private markets. The numbers here are impressive, showcasing their ability to raise and manage capital effectively. The risks are inherent to private equity, primarily illiquidity and valuation methodology. For those with the means, it represents an opportunity to participate in potentially high-growth private companies, but it comes with a long-term commitment and no guarantee of returns. Alright, that is our quick decode of this Blackstone filing. What do you think about the world of private equity and these massive capital flows? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe to Corporate Decoder for more insights into the financial world. And don't forget to join our Discord community linked in the description for even deeper discussions. Thanks for watching, and I'll see you in the next video.